Hello, this is a debrief of the SBR exam that was released by the ACCA in March 2020. The best way to approach this debrief for you is first of all to have a look at the exam and question by question, work through, try and produce your own workings. You can find the exam on the ACCA website and then listen to what I've got to say. What I would recommend is that you don't just read the question and the printed answer. I don't think you'll learn anything from that at all. So the best thing is open up the exam, have a look at the first question, spend some time working through, and then that would be a good time to listen to the next part of this recording. I'm going to start by looking at question one, which was called Hummings, which I'm sure you noticed was a question that dealt primarily with issues around foreign currency. It was, as always, broken down into several parts, and a lot of the marks are for explanation as opposed to calculation, so you cannot pass unless you explain what you are doing in clear terms. So we'll take ourselves through this question. In the very first part of the question, we were asked again to determine the functional currency of crochet, and that was worth 5 marks. So here we are. Question 1, Hummings. I will use abbreviations which you wouldn't use in the exam, but just so it speeds up the recording a little bit for you. But the first one was the functional currency of crochet. So you would put a subheading that says functional currency of crochet. That's a very, very common requirement whenever foreign currency questions are set. And what you need to do is set out your knowledge and then apply it to the scenario. It was worth 5 marks. So initially, in terms of setting out your knowledge, most people have learned the definition of functional currency before the exam, the things that suggest what is the functional currency. So I won't go through all of those, but as you know, the functional currency is connected to words like currency of day-to-day operations. What you have to consider, remember, is the primary it's the currency of the primary economic environment. What does that mean? It means, doesn't it, that what currency do they buy in and what currency do they sell in? So what you're looking at there when you're considering the primary economic environment in which the company works, you're thinking about the currency in which sales prices are denominated, the currency in which labour costs are denominated, and so on. Once you've set out your knowledge, then make sure we apply it to the scenario. And there's some debate here. There are 3 currencies knocking around, aren't there? But the principal 2 seem to be the dinar and also something called the grommets. It's an interesting word, isn't it? The dinars and the grommets. And you just have to have a debate about which one is mentioned most. So for example, I think that 50% of the wages are in dinar and 50% of the wages are in grommet. So, like a football score, that's 1-1. I think it's financed in grommet. That's 2-1 or 1-2 maybe. Tax is in dinar. Most of the sales purchases denominated in grommets. And therefore you might say, well, it looks to me like the grommets have it. There are other points as well. So it may well be, therefore, that your conclusion is that the functional currency is the grommet. There are other points you can make there, explaining, of course, why the functional currency is not the dollar, in particular because the company seems to have a high degree of autonomy. But I'm sure we can do quite well on that. And as long as you know the basic rules and pick the things out the scenario, we should be able to pick up 5 marks. In the next part of the question, we're asked to consider the valuation of some customer contracts. These contracts belong to the company Crochet. So we're asked to consider the value of the customer contracts. We're told specifically that this is the year ended 31st of December 2004. And when you read the scenario, the parent takes over the subsidiary. As you know, when you take over a subsidiary, all assets and liabilities must be measured at fair value. Now, what is a customer contract? Well, it gives some sort of rights to the business acquiring if that contract has been signed. Therefore, it's coming down to the fact that this is an intangible asset. So start by demonstrating your knowledge of intangible assets. Remember, please, don't write intangible assets are not tangible. That's like writing a banana is not a potato. So put down the proper definition. Intangible assets are identifiable. And remember that they're identifiable if they are separable, or they are identifiable if they convey legal or contractual rights. So set the definition down and then apply it, of course, in this particular question. So those contracts need to be recognised at fair value. And the fair value is 15 million grommets. And that's on the date of acquisition. IFRS 3 says when you take over a business, you've got to value the assets and liabilities at fair value. I just mentioned IFRS 3. Will the examiner be particularly impressed if you say IFRS 3? And the short answer is no. So there's no point in naming that standard. Name the rule, but not the standard. Now that's in grommets, of course. Our accounts, of course, our group accounts will be in dollars. So 15 million grommets on the date of acquisition, using the exchange rate on the date of acquisition, which was 8 to the dollar. 15 over 8 would give you a value of $1.9 million. That's on the date of acquisition. And then, of course, that asset afterwards will then be amortized. So the intangible asset will then be amortized over a sensible period. Presumably, the sensible period would be over the life of the contracts. Remember, this is only 4 marks. And of course, every year, if you amortise, you'll have a different figure at the year end. And of course, at the year end, like all other assets and liabilities, these assets will be translated at the balance sheet rate. I'm going to abbreviate that to CR for closing rate. And as you all know, exchange differences will go to reserves. So exchange differences will go to other comprehensive income. So a nice, sensible question about identifying the intangible. So remember again, when you take over a business, all the assets and all the liabilities must be measured at fair value. The next requirement, which was for 6 marks, very straightforward, was to calculate the goodwill and then explain what you're doing. And of course it states that you must take account of impairment. Probably easiest for most people to calculate it first. So when you calculate the goodwill, then you would need to set out a 3-column working. You must not do goodwill in 1 column, it won't work. So calculate it in the currency that they function in first, grommets, translate at the relevant exchange rate, and then put that across into dollars. So think about the standard working for goodwill first. Sometimes it's easier to type the pro forma first and then fill in the numbers. In any goodwill calculation, you need to take the consideration, add on the NCI, and then deduct the net assets. Deduct the net assets. In the scenario, the consideration was given in dollars. So $24 million. The exchange rate on that day was 8. So the consideration in grommets, 192. Again, the NCI was also given in dollars. $6 million. Exchange rate 8. Again, that's 48. The net assets are a mess because some of the net assets are already in grommets and some are in a different currency, being dinars. So as a normal student, I'd probably have got this a bit wrong. Remember, in calculation questions, if you just make one mistake, the impact on your mark will be insignificant, sometimes nothing. However, what they've got is some net assets already expressed in grommets, 43, plus of course 15. That's the intangible that we spoke about a little while ago. In addition, you've also got the assets in dinars, and I think that there were 50 million dinars. The exchange rate to the dinar was 2. Lots of scope there for the calculation going slightly wrong, but either way I think that comes out as 158. So from all of that, the goodwill at acquisition is 82. That's the position on the acquisition date. There's then an impairment, and obviously you would get the follow-through mark. It says that impairment is to be charged at 30%. 30% of 82 is 24.6. Remember, when you do a goodwill calculation, when you're retranslating, you'll have to miss a space for the exchange difference. But that means that the goodwill then at the soft P date would be 82 minus 24.6, which is 57.4. The key thing is to work out what the goodwill is at the soft P date. Goodwill, like other assets and liabilities, must be translated at the closing rate, which was 7. So in dollars, therefore, the goodwill would be 8.2. Now the higher skill mark, because since we bought the company, the exchange rate has changed. So originally, the goodwill was measured at, translated at 8. The impairment, you can use average or closing rate to see what's around in the question. They're both all right. So I've used the closing. So coming back to dollars, the first one is 10.3. The impairment is 3.5. So the exchange difference, which is the balancing figure, is therefore 1.4. So how many marks for that lot? Well, as a gut feeling, if part B2 is worth 6 marks, that's 3. So if you do that and you get it perfect, it's fine. But the easier marks are then with the explanation. And every exam asks you to calculate goodwill, so explanation marks are always pretty straightforward. So I can now set down my explanation. So, for example, explaining that again, goodwill would have been translated at the acquisition date originally, I'm going to abbreviate that to HR for historic rate, just for now. So we would use the historic rate at the date of acquisition. We're required to again use the closing or balance sheet rate at the soft P date. It's just explaining what you've done. The fact that, again, the impairment would go to the profit and loss account, and the exchange difference, as you know, would go to OCI. What the answer will always also mention, of course, is the fact that some of the impairment and some of the exchange difference would be allocated to NCI when they do that bit at the bottom of the profit and loss and OCI saying this is attributable to NCI. But there we are. There's the calculation of goodwill with explanation. I think most people, when they saw this question, were then anticipating that they'd be asked to calculate the exchange difference on the net assets. No, it's two calculation, isn't it? And this exam is about explanation. And so in the next requirement, which was for 4 marks, how would Quaver appear in the consolidated accounts? So again, it's specifically about the consolidation of Quaver. If you need to, pause the recording while you reread the question. Quaver has been purchased with an intention to resell. So Quaver purchased with intention to resell. And that takes you into the wonderful world of IFRS 5 discontinuances and assets held for sale. So it's a question about something being held for sale. That's not a difficult standard, it's a basic standard that you learned in financial reporting. So therefore, how would it appear in the consolidated accounts? How would it appear in the SOFP? And how would it appear in the profit and loss? IFRS 5 requires that when you have a subsidiary purchased for resale, in the profit and loss account, it should be presented as a discontinuance. In the bad old days, when we used to be asked to do whole consolidations, this question would have caused a load of trouble because if you hadn't spotted it, almost everything would be wrong. We don't have to worry about the nasty numbers, but the message is, of course, about a discontinuance, is that in the profit and loss, its results were presented as a single line. In the profit and loss, you represent all the continuing activities, line by line by line, and then till the end of tax, and then a single line, profit or loss from discontinued activity. In the balance sheet, what is Quaver? It is held for sale. And again, you can use the scenario with that, because when you read it, one of the things that you know about assets held for sale is that the sale must be highly probable within 12 months. In this scenario, the sale is expected within 8 months. Does it matter that something goes wrong, there's some kind of legal hold-up? No, life happens, doesn't it? So that doesn't change the classification. They genuinely thought it would be sold within 12 months. So therefore, we'd be looking at presentation in line with held for sale in the SOFP. That was part C. The very last part of the question was asking us to account for a bond, and in particular, its impairment. This was worth a big chunk of marks, 11 marks. There were calculations, but they were not revolting. We were asked about the bond and its impairment, first of all on the 31st of December 03, and then on the 31st of December 04. Two separate requirements. So again, I'm sketching this in plan form. 31st of December 03, that's the day they buy the bond. I'm going to write bond on the left because the bond will be a financial asset. On the right of the screen, I'm going to write the word allowance for impairment. because there's some doubt about the recovery of cash under the bond. They used to call this provision for bad debts. If you talk about bad debts, I think it's okay, but if you use the word provision, it's going to be very bad news for you. A provision is a liability. This is not a liability. It is the reduction in the carrying amount of an asset. So I set up an asset account with a debit balance, and an allowance account with a credit balance. The two of them are offset in the same way as you might set up a PPE account with a credit account related being the allowance for depreciation. So please call it an allowance and not a provision. So we're going to start by talking about the financial asset. When you first measure a financial asset, it must be measured at fair value plus any transaction costs. There are no transaction costs here, so I must measure this financial asset at fair value. The fair value of the bond is 10 million. As far as the loss allowance goes, as I said, it's a separate account which is offset against the loan asset. You can see that from the scenario, in December 03, we are at stage 1. Stage 1 means it's low risk, but you would normally have some kind of allowance because there's always a possibility of it going slightly wrong. So what you are expected to allow for there are 12-month expected credit losses. So that would be an allowance of $10,000. No need for any fancy calculations. 1 year later, the position has changed, hasn't it? 31st of December 04. How do we count for loan assets? Normally, we use amortized cost. Again, you use amortized cost, remember, if the business model is to collect the contractual cash flows. Usually, if you buy a bond, you're not planning to sell it on because you're not a bond dealer. So normally, you would account for it at amortized cost. So 1 year later, you'd be remeasuring the bond using amortized cost. So I would need to illustrate that with a little working. So I've got, if I just work it across the page, the brought down figure at the start of the year, this is X4, was 10 million. I'll do this in, I'll do it in $1 million terms, actually 10. Then you add on your finance income, which is your effective rate of interest, 8%, 0.8. Then you knock off your cash received, and that will always be, the 8% is on the carrying value. The cash received is always on the par value of the bond, sometimes known as the coupon. So the cash received or cash in, that will always be 5% on the 10 million. That's 0.5. So the carried down figure at the end is therefore 10.3 million. The key thing to point out is that the 10.3 is the figure that will form part of what's in the soft P. And of course, the 0.8 is the figure that will go in the profit and loss. So much of this exam is about taking basic transactions and explaining in simple terms to directors where they should put things. They've only got a few places to put them. The soft P, the profit and loss, OCI, maybe elsewhere in reserves. When we look at the allowance though, the credit allowance, the bad news over here, well, it looks now that we have gone from stage 1, we've now reached stage 2. And stage 2, remember, is associated with a significant increase in credit risk. A significant increase in credit risk, which means, therefore, that the allowance will now be based on lifetime expected losses. So I now need to look at lifetime expected credit losses. And you have to calculate those, but it's almost like opening a tin of beans for dinner when you look at the instructions on the tin and it says open and eat. So just do what it says on the tin. So I think once you calculate that, it comes out as 357k or 1,000. So 3%, I'm rounding this quite a lot, of 463 plus 5% of 6859, if I round quite a lot, I think that's 357,000. So the message is, again, it's telling directors where to stick things. The 0.8k finance income in the P&L. The 10.3 million carrying value of the bond to the balance sheet. This 357, again here, would be offset against that 10.3 million. So I will offset that against the loan asset in the soft P. In addition, when we look at the movement on the allowance, it was 10. Just look at the green numbers that I'm highlighting now. It was 10. It is 357. It's increased by 347. Therefore, the profit and loss will have an expense of 347k. It's like an old bad debt allowance, isn't it? 357 minus 10. And that will make its way again into the final accounts. Everything, explain what's on the soft P, explain what's in the profit and loss. And there is question 1 from that exam for 30 wonderful marks.